Hey guys, how's it going? Lee here. It's that time of the month again, guys, where I, in this video, will go through the most bought stocks in July 2020. Now, June and July has been a bit of an interesting ride. A lot of these sectors or stocks, won't really surprise you guys at all, but there will be one or two that are kind of surprising and kind of shows where investors are starting to put their money. And it's definitely not just into buy now, pay later. People are starting to venture outside to get that larger diversity outside of Australia. That's a bit of a hint there. But anyways, guys, if this is your first time to my channel, welcome on board. Please make sure you subscribe if you haven't done so for more content on finance. Otherwise, guys, leave this video a like, much appreciated as always. And of course, let's get right into it. So one of the first sectors that come out from the top 10 most bought stocks in Australia in July 2020 is the travel sector. So in this list, obviously, we still see Flight Centre and Webjet kicking it and doing very well, still staying relevant within the top 10 most traded stocks, with Qantas not being too far at number 11. Now, I personally don't see the attraction around buying these travel stocks because we've got reinfections, both domestically and internationally, and so we've got borders closing down. That means no flights are taking off soon. Qantas has also come out saying that no international flights will be had until mid next year. So there are a lot of limitations and restrictions. And my main concern, if you are buying into the travel sector, is that this might go on for quite a while. And my short-term concern is that when they come out with the next couple of reports, or even in the next report, the earnings are going to be, well, almost none. So I don't really know how that's going to affect the share price of the company, whether people have already priced that in, they understand that there are no flights, and a lot of people are holding on knowing that, within 5 years or whatever, there will be that recovery back to normal, which, is really still up for debate. But another reason why I really don't fancy the travel sector is that their margins that they operate on are extremely small. And if you want to know how small these margins are, you can check out my videos in the past that I've done on Virgin and also Qantas. There I went through the reports and pretty much explained how it all works. Even though Alan Joyce might be getting paid a fortune, the actual company, is getting, well, very little in terms of profits. And this is all kind of made worse on a macro level, given the fact that people are actually losing jobs. And I don't think the unemployment figures reflect what's actually happening because people are still employed due to receiving the JobKeeper payments. And so if we've already had a weakening leisure market, which was prior to COVID, like it was already bad before COVID, what's going to happen now when a lot of people are unemployed and these payments stop coming in at around March next year, or when that's re-looked at again? Because this time, the payments are already becoming smaller than they were before. But I've said this in a couple of my other videos. If you were looking to invest into a travel stock or the travel sector, then I think Webjet's probably the best one out of the lot. Just think about it. Qantas has taken on a lot of debt. They're not flying. Flight Centre has massive amounts of overhead with all of their stores, and they're known for their in-store service, right? They're known to be there so you can talk to somebody on the other side. However, Webjet, out of the three, operates online, and they've also really gone big with their web beds. So it gives them another vertical in terms of earning money, and it really diversifies them outside of just, flying planes. Not that they personally fly planes, but you know what I'm saying. Now, one of the other ones on the list is the NASDAQ 100 ETF provided to us by BetaShares. Now, this is one of the ones that I was talking about earlier in the video. It's really interesting because it kind of shows a sentiment that a lot of Australian retail traders want to have exposure to things outside of Australia. And what's better than being exposed to some of the hottest tech companies in the world, some of the biggest companies, let alone the tech companies, some of the biggest companies, period, in the world. So what is this ETF? So as I mentioned before, it's provided to you by BetaShares, and it's the NASDAQ 100, which tracks the top 100 companies in the NASDAQ stock exchange in New York. But Lee, what exactly does that mean, and what am I getting? Well, for the price of about $24, you can get companies that include Apple. Not sure if you've heard of them, but I've got some Apple stocks. Check it out. You'll also get some Microsoft, you'll get some exposure to Amazon, Amazingzon, Facebook, Google, and also the most controversial of them all, you will get exposure to Tesla. Now, in terms of the actual ETF, as you may or may not know, it's essentially made up of like a lot of tech companies, and I'm talking about 50% of the ETF is tech stocks or IT related. And you thought Australia's mining and banking sectors dominated the whole ETF? Check out the US. Crazy tech stocks. Now, when we're talking about investing overseas and investing into ETFs that will invest overseas for you, there's a few other things to consider. It's a bit too much for me to explain and go into this video. I can make a whole nother video outside of this for that. If you want that, let me know in the comments below about investing either domestically or internationally, the pros and cons about that, taxes and all that type of messy stuff. Let me know in the comments below. But yeah, NASDAQ 100 by BetaShares, great product out there. Now, it really doesn't take a magician to guess the top 5 stocks within this top 10 list because, well, it's been all over the news. I've made tons of videos about it, which I'm going to try to limit because, you know, I should be looking at some other stocks. But it's essentially, take a guess. Yes, you've got it right. It's the buy now, pay later space. Woo! Yep, exactly, that's it. And if you didn't guess that, well, subscribe to the channel, get the notifications, and you know what's gonna be hot in the ASX because I'll be putting a video out on it. And so because I've done so many of these buy now, pay later companies, I'm not gonna speak to them all individually. What I'm going to be talking about are 2 main things. First is more so the acceptance of buy now, pay later, with some big news coming out for Afterpay. And the second portion is a little bit about the capital raising and a bit of a warning to you guys as retail investors. So the first deal has to do with Afterpay partnering up with Apple and Google Pay. Yes, if you haven't heard that, they have recently signed a partnership that will see Afterpay on both Android and Apple devices. And this is a big deal because what that essentially says is that Apple and Google have gone, okay, we accept buy now, pay later as a legit and valid platform for our users to use. And honestly, how can you ignore the buy now, pay later space? With every single quarter, every single year, the user base continues to grow. And not only for Afterpay, but your Sezzles, your Zips, Splitteds, I'm missing a couple, OpenPay, and a couple other ones out there. I forget about this, it's just too many guys, let's be real. But they keep increasing every single quarter and they're not capturing the same audience. There's no way that, for the most part, that OpenPay is capturing the same demographics or the same audience that is already using a Zip or an Afterpay or any other alternative. So these are all new customers that are coming on board. Now, in terms of implementation, Afterpay is only implementing this in the US market for the time being, and it's already rolling out this month. Now, for the Australian market, it's going to roll out in the next couple of months. But yeah, it's just for the US market at the moment, and it's also for only in-store purchases. Now, predominantly when you do the Google Pay or the Apple Pay, it is an in-store, you know, you tap at the terminal to make the payment. I know there's a few options where you can use Apple Pay online, but that's very few and far from between. So what's the goal for Afterpay within this, and why are they looking to partner up? Well, essentially, just think about it. When they go to market, they have to expend a lot of money to explain the product and have that translate onto a new customer who has no idea how it operates, and it requires them to download a new app and understand a new system, who have an existing, my screen's dying. Now, if it's on an Apple Pay or a Google Pay who have an existing customer base already, it becomes much easier of a proposition for them to market the payment platform over to the new customer. Now, obviously, Afterpay is going to have a portion of their revenue or their profits eaten into by using Apple Pay and a Google Pay, but there is no fixed figure, and I think they're not allowed to leak it out. And I don't think any bank has leaked out that amount. It must be under the, you know, some kind of confidentiality agreement or a non-disclosure agreement. But in saying that, I did a bit of a quick Google McDougal, and it seems like it's a 0.04 to 0.06 basis points to be able to use their service and reach that larger customer base. Now, in terms of customer base, Apple Pay makes up about 5% of the global transactions around the world. So that means there are people who have cards already that can use their cards but would rather use their phones to be able to use Apple Pay. And I don't know what the Google Pay number is, but that's still pretty big just for Apple Pay alone. And that's projected to go to 10% of all global transactions by 2025. Now, another great bonus of this deal is more on the technical side, in that for Afterpay, they're not going to have to integrate software to each one of their merchants, which they're currently doing, to make sure, you know, that you can scan the Afterpay barcode and so people can use it within stores. What will happen is, because they're on Apple Pay, they can just use the normal terminal, the point of sale terminals, which you just scan your card on or insert your card and punch in your PIN. Now they can just use those and they don't have to integrate software, they don't have to provide anything else to the merchants. So essentially this move is going to allow Afterpay and potentially future buy now, pay later companies, which I think if any other company secures a deal like this, it's going to be big news, to capture some more customers without the millions of dollars in marketing. And also, once they start using it on Apple Pay, what we'll probably start to see is an increased frequency of usage by repeat customers, which is what you want. Now, having an increased customer base is going to lead into my second point, which is that it's going to allow them to leverage that to be able to raise more capital. Capital raisings. Alright, so second point, capital raisings about the buy now, pay later companies is that, well, they're everywhere. Every single buy now, pay later company is essentially come out with some sort of capital raise. Now, I'll try to make this short and sweet, but essentially just think about it, right? At the moment, we have like a huge hype train about buy now, pay later. Any single company that can put out that and say that it's gonna raise capital for growth potentials in, you know, whatever verticals it wants to go through, using all these terms and whatnot just around growth. And I mean, I totally get it. Like, a capital raising makes much more sense than taking out debt, even though interest rates are at an all-time low, because then, well, you're not indebted to any other institution should something go wrong, and it's essentially a free injection of cash flow for you to use for whatever purposes you want, even if you say it's for growth. And what a capital raising also does, especially during this time when there's a massive hype behind buy now, pay later, is that it moves the floor price of the shares up generally, because what you might have been comfortable paying for $2 for, if a firm is now willing to pay $4 for it, you go, oh, okay, then $4.50 to $5 makes a lot more sense. Oh, okay, $6 is all right, it's not too bad, when maybe a couple months ago, it might have only been worth $1 to $2. So it shifts the perception of how much the business is worth also, which is why we see a crazy spike in a lot of the share prices jumping up by 100 to 200%. So yeah, that's it essentially for the top 10, except for number 10 actually. I'll go into that right now. It's essentially NAB, and obviously outside of the top 10, we've got the banking stocks. How can I forget those guys, right? The big 4 banks in Australia, they're still there. No big news as of late in regards to the banks. Home loans are going through. A lot of home loans actually are going through. But yes, we've got NAB, ANZ, Westpac, and CBA within that mix. And the rate from the RBA is said to stay the same, and they're not going to make any changes, and I would rather them not go into negative interest rates. We also have some more ETFs. One's about sustainability, and the other one is from IOS, which is basically an index tracker for the ASX. Not surprisingly, there you also have Kogan, which is the king of Australian e-commerce at the moment, and also CSL, which I'll do a video on because I know a lot of you guys are new to the stock market and might not know some of these very, very old stocks. And the rest are essentially mining stocks, and you guys know my thoughts behind mining stocks, and if you don't, I don't really buy them, nor do I really care about mining, to be honest. So that's it for July. A very heavy bias towards buy now, pay later. We've seen a bit of diversity from investors also going into other forms of ETFs, which is great. It's great, especially that NASDAQ 100. That's a great one as well for people to get into, especially for the price. So if you made it to this point of the video, please give me some electric cord or plug emojis. Yes. Give me some of those plug emojis down in the comment section below. Let me know if you own any of the stocks down there. Otherwise, I'll catch you guys later. Have a great weekend. Cheers.